Okay, hello everyone. It's time. Can you all hear me? Yes, okay. And I'm gonna share my screen for you. Um, and please respond if you can see my screen. Um, okay. So I hope that everyone could see my screen right now, right?
Oh, is my mic on?
Okay, let's get started. So welcome to the BOS 251 midterm exam review session. So today we will talk about, just to do some of the recap, and then I will, give some instructions about the answers for this 22 pages, like questions, and also, you know, go go through some of the key concepts together with you. So my name is Yuan, and some of you has already joined my class, but some of you haven't, but it doesn't matter. So today we will just talk about chapter 1 to chapter 7, and then after that I will give some general advice for the exam and for the following learnings. So first of all, we're gonna start with the financial statement. Um, yeah, I just want to say before we start, you can download this one, this document, and open it together with me. So I will, talk about the answers, and you can have the answers recorded at the same time. And by the way, this session will be recorded and uploaded to Canvas later. So you are free to leave at any time if you have other priority to do. So let's start with the financial statement. So there are two most fundamental equations of financial accounting, and we have talked about this again and again for many times. So it it is assets equals to liability plus shareholders' equity.
Well, I
So
can barely understand this guy.
sorry, is it okay? Assets equals to liability. I won't type everything. I just type the beginning of the words to save some time. Right? Shareholders. Shareholders equity. So this equation will be very essential because you will use it when you do the journal entries. And whenever you do the journal entries, you use this equation to cross-check whether you did right or not. For example, you receive some money from others, your assets will definitely goes up because you receive cash. And at the same time, you have to examine like whether your liability change or your shareholders equity change at the same direction as well. So that like when you do the journal entry, please make sure that this equation still equals and it still makes sense. And also, it will help you to do the balance sheet because when you produce and generate your own balance sheet, you have to make sure that the left part assets equals to the right part liability plus shareholders equity. So it's a method to do cross check. When it's tight, you do the right thing, but when it's not tight, you make some mistakes. And the second equation will be debit equals credit. So this means when we do the journal entry, we have to do both the debits and the credits. And at the same time, the amount has to be the same. Like the total amount for debit has to be equal of the total amount of credits so that you did the right thing. And the next part we will talk about assets. So the definition of assets is the resources controlled by an entity, and it is the result of past events. And at the same time, it will have the ability to bring the company the future benefit or bring some value in the future. For example, we have cash account receivable, and also equipment. Oh. Okay, just make it like this. It's a bit messy, but it's fine. Equipment and also land. So something like this. You should be comfortable with these items already because we use these accounts a lot when we do the journal entry. Next is in liabilities. So liability, the definition of liability is it presents the obligations of the company and it's the result of past events, right? And it means the some settlements involved and outflow of resources. It means that when you have more liabilities, you will have more resources, you know, getting out of the company in the future. So for example, we have accounts payable, which is AP in short, accounts payable. This is different from the previous one, account receivable, right? So account payable and also bonds payable. Recording stream can be allowed. Yeah, this recording will be uploaded to Canvas. And we have bonds payable, and similarly, we have notes payable. And these are all just like debts. It's like this company owing your supplier or owing another company something. So you put this amount into bonds payable or notes payable. So it's like the liability that you have. Okay, so next concept will be shareholders' equity. So how do we calculate shareholders' equity? Since we already have the assets and we have liability, we just do the mathematics. So the shareholders' equity could be the difference between the total assets and total liability. It also represent the value belongs to the shareholders. So for example, the shareholders, this accounts we have preferred shares. We have preferred shares and have common shares. And we also have retained earnings. Okay, return earnings. So these are the items and accounts that we use frequently and normally. And next thing I will talk about the summary of a chart of the commonly used accounts. I mean, this chart will show the movement of accounts when you use debit and credit. So for assets, when you debit an assets, it will goes up. And when you credit an assets, it will goes down. And when you debit a liability, it will goes down. This is different from the asset. It's on the contrary. And when you credit a liability, it will goes up. Right? I think this is quite straightforward. We have, talked about this for so many times in the tutorial already, and of course in the lectures. So the question, let's do this together. Is it an assets, liability, or shareholders' equity account? So for cash, so it is assets, right? You have more cash, it means you have more assets. It's quite straightforward. And for common shares, it's the equity that you issue to the public to aggregate money. So this is shareholders' equity. And for return earnings, it is shareholders' equity as well. And for prepaid expenses, This could be a little bit tricky because, normally when we say expenses at the end of the phrases, it always falls into the category of expense. But prepaid expenses is like something that you prepaid for the future, like you prepaid your electricity or you paid for your rents in the following years. So it's some assets. It will bring you some value in the future. So in the future, you don't have to pay this rent anymore, right? So it belongs to the category of asset. Yeah, and next one, income tax payable. When you see payable at the end of the phrases, it's always related to liability, right? It means something that you have to pay in the future. And when you next thing, goodwill is when a company doing the merger acquisition. Actually, you could potentially paying something more than the booked value of a company. Then this difference will be booked into goodwill. It's kind of the assets you have because it means you paid for this goodwill and it belongs to you afterwards. So it is the asset could bring you some benefit or value in the future. And next one, advertising expenses. Which one does this belong to? So this is a bit tricky because advertising expenses is just expenses. It's not belongs to assets, liability, shareholders' equity. It's not. It's just expense. Yeah, that's it. Okay, let's move to the next part. These are the very basic things, but I will go together with you again. So the statement of financial position is also called balance sheet. And still, we have to remind you the fundamental question: assets equals to liability plus shareholders' equity. So whenever you produce your own balance sheet, please make sure that you put assets at the left side and the liability and shareholders to the right side. And this assets needs to be divided into two parts. One is current asset, another is non-current assets. So how these two are differentiated? Current assets are some assets expected to be converted into cash, sold, or consumed within 1 year. And non-current assets is obviously above 1 year. And liability has to be divided into current liability and also non-current liability. So it's similar towards the assets. When it's within 1 year, is current liability. When it's more than 1 year, is non-current liability. And also, please make sure that this equation makes sense when you create your own balance sheet. Please make sure that the total assets will equals to the total liability and shareholders' equity. So the left side has to be equal to the right side. Otherwise, you are making some mistakes. And next thing, statement of comprehensive income. So what is this called also? It's called income statement. It's called income statement. And the fundamental equation for this will be revenue subtract expenses equals to net income. So as you can see, you put when we have to, make a income statement, like to calculate the net income, we just put all the revenue here. You put the sub accounts of revenue like sales revenue, service revenue, interest revenue here, and you sum it up, like you got the total revenue here. And then you put all the expenses like cost of goods sold, rent expense, like wages expense, supply expenses, you put all the expense here and you sum it up, you get the total expenses. And then you do the math, you use the revenue to subtract expenses, and then you will get the net income, right? This is quite straightforward. And let's move to the next concept. There's another one that is quite important. It's called statement of changes in equity, right? So it shows the movement of the equity, and is part of this statement is return earnings. This account we should be very comfortable and familiar with. So this return earnings is also shown in the balance sheet in the shareholders' equity part. And as you can see here, like return earnings is in the shareholders' equity. So how to calculate the ending return earnings? So it's like a rolling base. So you have the beginning return earnings, and you have to add the net income. You have to add net income from a certain period, from the chosen period, and then you subtract dividend. You subtract the dividend that you pay to your shareholders, right? And then you get the ending balance of return earnings. Okay, next thing. The statement of cash flows is also called cash flow statement. It's also called cash flow statement. And it basically shows where the cash is going or where the cash is coming from. So the cash flow is always from operating or investing and financing activities. For operating, it's like day-to-day business activities. For example, you collect the accounts receivable from your customers, from your from other companies, and also it could be the cash income from the service or selling product, some stuff like that. And for investing part, it is like the purchasing or selling of assets. For example, you purchase some of the equipment, you purchase the computers, the PCs, then it is the outflow from investing. And if you are selling your current assets, you're selling your lands, your equipment, then you get the income from the investing activities, right? And next thing is financing. So financing means you are using or reducing debt or equity. For example, you are borrowing money from the banks, or you are paying off your debts towards the banks, or you are issuing the new stocks for the public. This is all related to financing activities. Okay, let's move to the next one. So how are the balance sheet, income statement, and statement of return earnings connected? So actually we have talked about this in the tutorial before. So the income statement produced net income, right? And net income was added to return earnings because we use this equation here. Sorry, here, right? So the net income gets added to return earnings, and return earnings gets reported on balance sheet. So the balance. So this the balance sheet, income statement, and the statement of return earnings are connected to the following accounts. It's on balance sheet, and full income statement, net income. Okay, again, let me repeat. The income statement produced net income, and net income gets added to return earnings, and return earnings get reported on balance sheet. Okay, that's it. Let's move to the next question. The stock market sells stocks to financial students at Southern, and the controller is extremely disorganized and cannot find the entire of the financial information. However, they know that their assets and liabilities are correct. On December 31, the controller reported 20,000 in equipment, 10,000 in bonds payables, and 15,000 in patents, and 1,000 in salary expenses. How much will the stock market have in shareholders' equity on their balance sheet? So first of all, I recommend you to put the fundamental equations here. Assets equals liability plus shareholders' equity. You put this equation here to remind you, like in case you make some mistake. So what we have for assets, 20,000 in equipment. This is assets, right? So we have equipment, $20,000. And what else we have? And this is assets as well, the patent. It's intangible assets. It's some of the copyright or patent that a company could have, and this patent could, bring values and benefit to the company. You can just license it to others, or let others to use it, and then you collect the money, right? This patent is 15,000. Do we have other stuff here? This 10,000 bonds payable, it's liability, because it's payables. And then this 1,000 in salary expenses, this is not assets, this is just the expense. So this everything we have for assets, and then it equals to 35,000. That's it. And then what do we have for liabilities? So we have bonds payable, right? We have bonds payable here. How much is that? And that's everything. That's the 10,000 we have for liabilities. And this equation makes sense right now because we have assets and we have liabilities. We have this two part, right? And then you just have to do some calculations. So shareholders' equity, I'll just copy it from here. So shareholders' equity equals to 25,000. That's it. And I have to say this 1,000 expense is already included in return earnings of shareholders' equity. So you won't do anything with this 1,000 because it's expenses and it's already calculated to get the final number of 25,000. It's already included here. So that's the answer for question 3. Let's move to the next part. So next part, we will talk about accrual accounting concept. There are 3 golden rules of when you do the journal entry. First of all, you always do debits and do credit and make the debits equals to credits. Okay. And you always debit expenses, right? You always debit expenses. And you always credit revenues. When you debit expenses, expenses goes up. When you credit revenues, your revenue goes up. So this is, like we always have more expenses happening, and we always have, making more money and make more revenues. So that's why we always debit expenses and credit revenues. But there are some of the exceptions. If you are making a correcting or if you are making an adjustment, or closing entry, then you make the opposite direction. You can, credit expenses or debit revenues. Okay, let's talk about the next question. So the Merchant of Tennis is a sport shop in Shakespearean times. After discussion with the auditors, they discovered that several adjusting and correcting entries are still required. So what is required? Please make the year-end adjusting entries required for the last day of 2022. And the Merchant of Tennis is counting on you to be on it. Audit you can be. Okay, so the Merchant of Tennis purchased a 2-year insurance policy on July 1st, 2021. Please mark this date. Okay, and on this date it debited the insurance expenses by 40,000 and credit cash. No other entries pertaining to insurance have been made until today. So they made a mistake actually. At the day of July 1st, when they firstly paid this amount, they are paying something for the future. So they should have debit prepaid insurance, right? If they do debit insurance expenses, they are actually paying something for the past, but this is for the future. So they make a mistake and we need to correct this error. So what is the error? They should have debit prepaid expenses, prepaid insurance, and credit cash. The mistakes they made. So what we should do, they make a mistake, so we should make the reverse one, right? So they debit insurance expenses and credit cash, and we do the opposite. We debit cash. Credit. This is 40,000, and this is 40,000 as well. So by doing this journal entry, we are doing the reverse one, reverse the entry. And then after that, it goes to the original point, and we will do the right entry. And here, the debit prepaid insurance. Credit. Put 40,000 here and 40,000 here. Okay, so by doing this second journal entries, we're doing the right entry. And then, as you may notice, we pay this amount at July 1st, 2020. Oh, this isn't, sorry, this is 2021. This is 2021. Okay, my mistake. This is 2023. And right now it's already the last day of 2024. Do you have to do Okay, give me a moment. Let me finish because I only have a few minutes left. Okay, so standing from this point, you paid for the money for the future, but till the last day of 2024, 1.5 year has already passed, right? So we use 1.5 years out of 2 years. It's like 3/4. This is how much we have already used the money that we paid, right? So we debit insurance expense. And we have to do a little bit calculation because we paid 40,000 back then, and 1.5 years has already passed out of these 2 years. Right? This is 30,000. And then you have to credit prepaid insurance. This is 30,000 as well. So by doing this, actually my understanding is you put so much of the amount in prepaid insurance, and because you use this, like this amount, 30,000 has already been used, then you have to transfer this amount from prepaid insurance into insurance expenses. So it will transfer from the assets into expenses, right? And if you combine all of this together, you got the condensed one, like debit, prepaid insurance, and credit insurance expenses. Okay, so the yellow section is the combined entries. So you just add all of this together because some of the accounts is the same. So you just add the number together, you get the yellow line. And you can if you can do this yellow line at the exam, it will be fine. And you can just start from the beginning, and this is much more easier for you to understand. Okay, what we have. Why 1.5 years? It's 1.5 years is because you paid this on July the 1st. July the 1st, 2023. So from this time till the end of 2023, it will be half a year. And one more year is like from the beginning of 2024 until the end of the 2024 is another year. So starting from the last day of 2024, from here to the end is 1.5 years. And why debiting cash? Is it just so it balanced out? I didn't see any part in the question where it said we receive cash. Okay. Oh, that's a interesting question because they used to credit cash. So we assume that we have already received this amount, right? But I think it depends on the context. If you read from the context or from the question, if they credit cash, it means you assume that they received the cash. If they used account receivable, then probably you could use the account receivable. But for this, is they paid this amount by cash, right? So you assume that they use cash. It's not account payable. And another thing is like the other company probably will not allow you to use the account payable to to pay them like in advance. It's not working like that. You have to pay cash to have the prepaid expenses. Okay. So is it everything that you initially did still accurate, including note about error? Yeah, this is accurate. So the previous one, like this thing they did is not accurate. So they made an error, they made a mistake, and we are trying to correct the error, doing the reverse one, and then do the right thing again. And then we transfer this amount from prepaid expenses into expense. This is what we do. And what's the next question? Can you explain again where the resources came from? Okay. So this 10,000